Tim and Mo. This is actually a very impromptu recording. Over the last few days, I think since the conversation I had with Palesa, what I've been doing is essentially taking your reactions, taking a couple of phone calls, a few clients said, can you please manage my portfolio? I think somebody sent me what do you call this? A screenshot saying there are guys that are selling signals, forex signals. How come you don't do the same thing? And I've thought about it obviously a lot, and I think just to debrief some of the things that came up in that conversation. And I think what I'll do is I'll take you through my methodology in this call. Let me just make notes just so that I don't lose my train of thought. It being impromptu. So what I'll do is I'll take you through my investment methodology, and I'll talk you through the challenges of why it's hard. From an ethical perspective, to make people pay you for the sort of work that I do, especially because I'm not licensed. I'm educated in it, I'm qualified in finance, but investment management requires its own licensing, that sort of thing. But I am 100% comfortable in my expertise as an investment, as a, what do you call it, a finance expert. And that is why I am comfortable if the JSE or those guys come after me because I was trained in reading financial statements. And if I'm going to get in trouble for reading financial statements, then who's qualified to do it? Yeah. So the first thing is I'll take you through my methodology. I'll probably do it in my own order. I just want to take notes of the things that I do want to discuss. Challenges in pricing / monetizing. Discuss the 2 and 20 model. I'm going to discuss the concept of value. I'm going to discuss the concept of long-term in there, right? Maybe I'll even discuss the concept of risk. And risk or risk appetite. I think that's the best descriptor of that. And then I will close off by saying perhaps something along the lines of how to choose a financial advisor. How to choose and evaluate a financial advisor. Awesome. So yeah, let's get right in it. So if you check my investment methodology, and I will show you an example, and this is actually what prompted me to finally record this session. I will show you an example using Afrocentric, right? My investment methodology is what we call the value investing methodology. As espoused, is that big word, as was explained or as was invented by Benjamin Graham. And essentially what that methodology says, it speaks about an investment being, I'm just trying to open it on the side here so that you guys can follow with me. There we go. Just go where to find it. Just Google Finance Hard. You go on there, right? As espoused by Benjamin Graham, and he essentially says that an investment operation. So that's the first thing that you need to understand. This is an investment operation. This is not a which share do you think I should buy? This is a I have little to no debt. I have been saving my money. I've got 3 months expenses in what do you call this? In savings. I've got a comfortable lifestyle, and now I'm looking for ways that I can grow my money a little better than the bank. And as I say, that's an investment operation. Now I would like to come to you and say for the next 7 to 10 years, can you help me in building bigger wealth than I currently am in the process of doing? I've spoken extensively about how I'm not a fan of property. And the simple reason I'm not a fan of property is because I believe that property is like a bank. You go there to park your money and then you expect inflation to pick up the value of your house. But it's not really picking up the value of your house. It's just maintaining the value of your money as inflation goes up. So people see that and they say property always goes up in value. That's not the case. It makes sense that a house that you bought in 1992 today will be worth 10 times that, but it also makes sense why a bag of mealie meal today will be 10 to 100 times worth of that. So with that logic, I would say invest in mealie meal. That makes more sense. So that's why I don't go that route. I'm not gonna bash property. I think it's a great capital parker, a great place to put your money if you don't want it to grow and you'd like to preserve it. And those often are the challenges that millionaires have. At a multi-million rand level, it's difficult to double your money. You can imagine Patrice Motsepe, if he wants to double his money, there's almost very little vehicles that he can use to do that. So to put it in property would be a good place for him to just park it so that it doesn't lose value while he's looking for other opportunities. I digress. I don't like talking about property. So you're gonna type on my website, your mouth is moving, but you're not saying anything. So I don't have to type the whole thing because my website is a bit smart. Figure it out. And the reason why I wrote this article, you'll see it's a 2019 article. So we entirely 2 years in, and I think I'm just gonna go one back, right? You'll see that there's where I said 2 whole years of silence. That's another article that I wrote. But on this one, yeah, your mouth is moving. January 2019, we're now in May 2023. So it's a good 4 years without me writing anything, but with me referring people to this particular article. And the reason I wrote it was because the investing world will have you considering or believing that it's difficult to invest. You have to read all these books. I mean, if I can perhaps stop sharing, not my screen, but essentially the logo at the back and show you, let's see if I remove virtual background and show you my library at the back. Um, Essentially, these are all the books that I've read. So they essentially cover that entire bookshelf and then that second bookshelf there. So I've got quite a collection of books, and this is not even the half of it. And all those books are essentially trying to convince you or trying to teach you how to invest and how to do this thing by yourself and what have you. And I think at this point, by the time I wrote this article, I had been investing since 2013, so for a good 6 years. So I think this year we're celebrating 10 years of me investing. And what came at me at that point in time was the fact that you're getting a lot of information, but nobody's hearing you. So essentially, your mouth is moving, but you're not saying anything. When you're done talking to people about investing, they don't know what to do. They sit there and they're like, okay, I get it, I like it. And a year later, they haven't done anything. Whereas other markets, for example, property, crypto, they will have a slogan, jump in, get in, make a million, do this, do that, do this, right? So I decided to write this article so that by the time you're done reading it, all these books that I've read, you essentially can understand what is the crux of what they're saying. And I think if we have time, I will cover what we call philosophy, which will probably also be covered in these considerations of value, long-term risk appetite, that sort of thing, right? So that's the background to why I wrote the article. In simple terms, as I said, um, Ben Graham describes an investment operation or investing as an investment operation. So you have done all this background work and you've come to the point where you say, I now would like to put my money somewhere so that it can grow a bit more. Kind of like what Palesa did in the previous episode. Check it out here or here or here or here. I don't yet know where it is, but it's on my channel. Listen to her story, phenomenal. She had saved up quite a bit of money and then asked me, what do I do now? I'm stuck. I don't know. Right? It's an investment operation that allows you to go through thorough analysis. Thorough analysis means that you're going to go on the website of your favorite company. And for argument's sake, I will take you through the website of my favorite company, which is Louis, right? Please don't go and buy this share now because this at the moment is not a share recommendation. When you get to the home page of Louis, you'll go to investors. Under investors, you'll go to either annual financial statements or integrated annual reports. Initially, I like to start with annual financial statements, but then I very quickly graduate to integrated annual reports. The reason I like the integrated annual reports is because there you get the other story around it. Oh, I think what was nice to see was our brands, essentially what companies they have. Let me just go back home. I like showing that off, especially to the older folks. They didn't know this. Louis owns bears. So you don't see Louis in Pretoria, Cape Town, whatever, and you think, Louis doesn't exist anymore. Who still invests in that? Some of you don't even realize that UFO Furnitures, when you drive past Marlborough, that big, lovely building, black building, that's owned by us, Louis, 100%. Bought it cash for 324 million or something like that. I remember the deal a few years back. But anyway, that's Louis. You go to the integrated annual reports, you open it, and you will see that there it gives you basically for the last 20 years. You can pick any year and you will see the annual reports there. And then there's a 5-year review, which is always helpful, but I'm going to open the integrated report itself. So that I can take you through all the aspects of it, right? And this is what we call, so we've spoken about investment operation, right? And now we're talking about thorough analysis. This is what thorough analysis means. So your friend says to you, buy shares in Capitec. I saw they went up last month or whatever. That's not thorough analysis. That's just your friend giving you tips. And I wouldn't advise that you take that. Versus your friend says, go buy shares in this company. You go on the company website, you go under investors, you go under integrated report. Now you have done a bit more than your friend has done, and you deserve to make a bit more money than your friend will make because you have now engaged in thorough analysis. All right. Under thorough analysis, you can see there it talks about the group profile that basically says who we are as a group, the value creation and the business model. That will explain to you how we make money as Louis. So we sell people furniture that they can't afford on credit, and we use the furniture as security. If you fail to pay out in the 24 months, we take the piece of furniture back and resell it to somebody else. That's a business model. That's how we make money. We charge interest on that credit that we've given you. You take out insurance on that credit or on that item that you've taken out. So we've essentially got 3 to 4 ways of making money in just that one strategy, which is why I'm not an advocate of credit, but I invest in it because it's good business sense. And if adults choose to use credit to buy their assets or to buy the things that they consume in their homes, they have a right to do so. It's what we fought for. Then you've got the strategy and targets. Then they speak about the material issues and risks, as well as the investment case. So they're explaining to you who they are as a company and why you should invest in them. Do you understand now why this is called thorough analysis, right? Then the sustainability report and the stakeholder engagement. Stakeholder engagement essentially talks about what is the feedback that they get when they speak to their suppliers, to their shareholders, to their customers, to their regulators, to the banks, to government. All of these people, what do they have to say about a company like Louis existing? And so you start to get a fuller picture of what is this thing that I own. So whenever someone says to you that shares are risky, I'd rather invest in whatever else, you say to them that actually, why would owning a piece of a business that goes through so much length of explaining what it is that they do be risky? That does not make sense. You're just showing that you haven't done any thorough analysis. As some of you may know, Louis is currently about 90 years old or 89, it's going on there. If they've been around for 89 to 90 years old, they probably know what they're doing. And for you to come and say it's risky, I would wonder, based on what? So we continue. Then they go under leadership. This is my favorite section outside of the financial statements. Under leadership, the reason I like it is because you get the chairman's report, aka I'm Chairman Mo. What the chairman does is he gives us a long-term picture. He gives us a holistic picture. This is my understanding of the context of this company and how the last year has gone. And this is why I think we can still be optimistic about our existence as a company and a corporate social citizen, right? Then you get the board of directors, they show you who they are, then they show you the CEO's report. The CEO essentially talks about the company. So this is what happened in finance, in marketing, in HR. I draw your attention to the following challenges that we have overcome like this, the following risks that we're going to consider overcoming like that. And then those two reports give you comfortable information about what's happening in and around the company. Now you're in a much better position to understand when inflation goes up, how does that affect my investment? Oh, okay, is it a bad thing or is it a good thing? Then they show you the executive management. So it shows you the head of HR, everybody else, supply chain, managing credit risk. How do they do it? I like Louis because they don't have credit. Then we get to my favorite section, the financial review. This is where I use this best friend of mine, a calculator. And I will even argue that you can use this, a cell phone, regular cell phone calculator. And for me, that is how doable investing is. You get the CFO's report as well. And what you want to start doing by this time is theoretically you should have done your calculations, and I'll show you now what calculations I'm talking about. And in those calculations, you will see a picture. And when you read the CEO's report, the CFO's report, and the chairman of the board's report, that picture that you saw for yourself should be painted somewhat. You should be able to say, these guys are talking the same thing that I saw in the numbers. And if you saw the numbers and you had a concern, you should be able to say, I'm glad they addressed this. If you see a concern in the numbers and the CFO doesn't talk about it, the CEO doesn't talk about it, and the chairman of the board doesn't talk about it, don't think that they forgot to do it. No, 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 no. That is a sign of either fraud or them trying to fix your attention somewhere else rather than where you actually want an explanation about, which is the whole purpose of preparing financial statements, to give our stakeholders a report. So if they're not talking about the things that you as a stakeholder would be concerned about, then what are they talking about? And then here we have our 5-year review again. And then you've got the rest of the document, which is governance. They've got a remuneration report. That's where you can see how much everybody earns in the company, except everybody above in management, that sort of thing. And then the last part is the shareholder information. This is where you get to see who owns shares in this. And what I like about Louis, what I've seen about Louis, their shares are owned by the Canadian Pension Fund, I think Ellen Gray, a few of those guys, and then a few individual major shareholders. So it kind of also gives you the understanding that, oh, if these guys are owned by a pension fund, they actually then are in the business of paying out dividends because the pension fund is going to have to take those dividends and pay them out to their shareholders. Those of you that knows me will know that I love dividends a lot, and that's because it's cash back. None of us live in a world where we understand this profit and loss, these red, green things that pop up on the news where they say the stock market did well or not. Dividends is where you get to see your cash, but I'll touch more on that. So when you go through the annual report or the integrated report, as you will see, that is what we call a thorough analysis. Now we're still busy with the definition of investing. Investing is an investment operation. And as I've discussed how we arrive at this operation, this is part of the operation. Putting yourself in a position where you're ready to take more risk with your money. That involves thorough analysis, or that through thorough analysis, and this is where the outcome comes in, ensures the following: safety of capital. So this is the outcome. I don't want to lose my money. Well, you're in the right place because an investment or an investment operation, by definition, is something that, after thorough analysis, it guarantees you safety of capital, safety of your money. That's the first thing that it guarantees you. And the second thing that it guarantees you is a satisfactory return. Would you look at that? You get your money back and you get a satisfactory return. What is a satisfactory return? Well, Chair, my money was in the bank and I'm not happy with it. Oh, okay. Now, what would you be happy with? Do you know that there are government bonds that give more than the bank? Let me have a look. I look at the government bonds. They're giving about 8 to 9%. Yeah, that's okay. It's a lot better than what I'm getting, 2% there by my bank, but it's still not yet satisfactory. What are you looking for under satisfactory? I don't know. What's a good return? Well, as a start, it probably is anything more than 9%, because after 9%, very few people are willing to guarantee you a return. So now we know that when we go on investment operation, we are going on something that is, first of all, requiring me as the investor to take care of business, take care of home, and arrive in this position where I can take on risk for me to be able to earn, first of all, keep my money safe, and second of all, to get a satisfactory return on that money through thorough analysis. And then it concludes by saying anything else is a speculation. What a comfortable definition. It's an investment operation. You get your ducks in a row and you come and you sit down. And then you say, I am ready for this. You then take out a report from the company that you want to invest in. And you do a thorough analysis. You read a few things. Look at this: credit management, operational management, capital management, material risks, action plans, strategy during the pandemic. All of those things, you read about them. Oh, okay, retailing trading conditions. There we go. You read those things: legislation, business threats and weaknesses. Here, key group risk, industry trends and consumer behavior. They actually spell them out for you. Cyber risk, you know. Hi, Mamzo. Guys, if this is your mom, give her a shout out. And it covers it all. Then it comes to the investment case. It says Louis offers investors exposure across Southern Africa's retail customer markets through its portfolio of well-established traditional brands operating in the low to middle income credit market and upper income cash customers through UFO. The following factors motivate an investment case for Lewis Group and should support competitive long-term returns for shareholders. Here it is. It tells you why you would want to invest in Lewis. That is thorough analysis. Your friend says to you, invest in Capitec. Why? Why is, give me the investment case for Capitec. And he says, Joe, imagine how many people bank with Capitec. I'm sure you know someone with a Capitec account. Well, that's part of an investment case, but if you actually go through the thorough analysis, there it is, right there. Strong balance sheet, proven credit risk management, customer loyalty and engagement, extensive retail footprint, diversification across income segments, exclusive merchandise, favorable positioning, even in challenging retail environment. You don't have to think about it. You just have to do an analysis. You just have to analyze, get the information and analyze it. And you can tell by now, you deserve more money than someone that is sitting at home and doing nothing. What time is it now? 6 o'clock. People are getting ready to cook. People are getting ready to travel back from work. People are getting ready to do various other things. Why should I make more money than them? Because I'm busy reading the investment case. I'm busy planning where am I going to put my money. I've just worked 8 hours today making my money. And now I'm spending at least an hour or two deciding where to put it. And therefore, I deserve a bit more money than the person that does not do this. And so we continue. That's the definition of investing. Anything other than this is speculating. Your cousin that says, hey, Joe, borrow me 10,000 Rand. I'm interested in the logistics business. You know that the logistics business, you can never go wrong with trucks, what have you. If you don't do a thorough analysis, give me a report, give me the cash flows, that sort of thing, you are speculating. You might be doing it in a suit, you might be doing it with an iPad, you might be doing it in a boardroom with coffee, with tea, with water, with formalities, with a pamphlet, with a book, but you are speculating. For as long as they're not giving you numbers and guaranteeing you the safety of your capital as well as a satisfactory return, not just a satisfactory return. Yeah, but Brian had high risk, high reward. Really? Let me continue through the integrated report. As you can see there's the sustainability report. My favorite sometimes is the group footprint. The group sustainability program has been aligned to the following SDGs: no poverty, zero hunger, good health and well-being, quality education, decent work, and economic growth, climate action. And it reports on those things. It says, this is how we have done this. This is how we have supported education. The Tsiba Schools Initiative bears, as I did brag, that if you buy furniture, how go bears, you guys, the better than us, families, you're actually contributing to my bottom line. I appreciate it. The impact of climate change, those sort of things, some of the physical risks involved. You know, you take it through the chairman's report. Chairman explains how he creates shareholder value, the board and governance. Let me even read the first paragraph of the chairman's report. Says that South Africa welcomed the opening up of the economy when COVID-19 restrictions were relaxed and activity started to normalize. The country has encountered severe socio-political and economic headwinds, with consumers undergoing financial pressure. Then he speaks about the civil unrest in KZN. The group had adequate cover for the loss of stock and damage of assets, and the majority of insurance claim had been settled by year end. So he's already given you a report. The national unemployment rate for the first quarter is this, and he explains how many South Africans are jobless. While South Africa's economic outlook is weak, Lewis is well positioned to grow market share in this environment. We are no strangers to operating in challenging trading conditions, and the board has full confidence in our experienced and stable management team to lead the group successfully through the current downturn. And that's our chairman of the board. There's our board of directors, their ages, their qualifications, you name it. Our CEO then will say it is pleasing to report to shareholders that the group delivered highly competitive performance despite the ongoing impact of COVID, unemployment reaching record levels, and KZN and parts of Gauteng. Imagine, this is your investment they're talking about, that high risk that people talk about. The CEO is telling you that it's pleasing to report that we've delivered highly competitive performance despite those things. And he speaks about the strong operational performance. He speaks about the high quality of the debtors book, i.e. the people that we've borrowed money, they are paying us, as well as the expanding store print. And he's showing you that in 2018, 68% of customers were paying us back. In 2022, 79%, almost a distinction in high school and a distinction in varsity, are paying us back. That's the CEO's report. We then continue. If you have these cultures, you're welcome. Explains about merchandising, that sort of thing. Then we discuss how many of these shops we have. We have 143 Bears stores, 485 Louis stores, 45 UFO furniture stores. You cannot tell me this is not a thorough thorough analysis. What I wanted to get to was this. So we see the CEO's report, CFO's report, the financial guy, us, me, says the group demonstrated its resilience in challenging retail conditions to deliver strong merchandise sales and operating performance for the year, with headline earnings increasing by 21.2%. We're talking about the 9% that you get at the bank or at bonds that you're not happy with. Well, there we have a number for the first time, 21.2% in terms of headline earnings. Would you be happy with that? That sounds to me like a satisfactory return. Anything else is speculation. And then we get to my favorite part. So he analyzes it for you. So for those of you that are worried that, oh, but I didn't do accounting, what have you, reading the director's report and the CEO's report actually shows you snippets. So you see he's taking out snippets to show you that when you go through the financial statements that you're about to see, look at these numbers. So look at over here, analysis of costs. So they guide you through this exercise. Look down here, analysis of costs. So you can actually know, if we look here, he shows you, oh, this is how much we're paying in salaries, employee cost, 1.4 billion. This is how much we pay in admin and IT, 345 million. This is how much we pay in marketing, 280 million. What about transport and travel? Those nice long trucks that you always see zooming past you with beds. You'll see them going up a hill if you live in those types of villages. And Spale Louis, we spent 279 million on that. And then other operating costs and depreciation and amortization, and we show you that we are spending 3 billion under costs. You ask your cousin, Taz, what happened to the 10,000 rand that I borrowed you to start that truck company? No analysis of costs. Sorry, cousins that do that. I'm not trying to ruin your name and your ability to get capital back or borrow capital from your family. It's just reading report. Come on, you know? And then it gives you a 5-year review. So it shows you returns to shareholders average. So it says the average is about 10%, more than our 9%. And I'm gonna show you how to get better returns than this, because this is on average. But what I'm going to show you with my investment methodology is how to get above average, because you do thorough analysis. You deserve better returns than the average. And it shows all of those things over a 5-year period. And you can look at that and decide, am I looking for this or not? Then we come to my favorite, the income statement, as well as the balance sheet. It will show you there, for example, that profits have grown from 6.7, revenue from 6.7 billion to 7.2 billion. Operating profit has roughly stayed the same or decreased a bit from 695 million to 667 million. And then the net profit at the end, and then the earning per share. That is because now you are a shareholder. It's telling you how much you are earning per your one share. And it says there's 730 cents. Last year, you were earning 576 cents. So last year, you were earning 5 Rand 70 on your share. This year, you are earning 7 Rand 30 on your share. That is an increase of 21.2%, as he had said to us earlier on your share. And then somebody says it's risky. There you've got the auditor's report that shows you this is who audited Lewis, it's PricewaterhouseCoopers, and they tell you that we are satisfied that these numbers that are reported here are not a lie. We have checked them, we have double checked them. If they turn out to be wrong, you can actually apply to an ombudsman or your government or your lawyers or your whatever and say, what does the auditor have to say? Because last year they approved these financial statements. And then it shows you earnings and dividends per share. What I like about Lewis as well, and this is some of the things that will come up, some of the factors that you can't touch when investing, right? When someone says, how do you know this is a better company than another one? I like Lewis, for example, because they make it easy for me to analyze it. They're not hiding information in all sorts of funny places. There are companies, if you're looking to see what dividend they pay, you will page through the whole document, type in the search. I don't even have a search function here on this online PDF, looking for the dividend per share of this company, and nothing comes up. And the reason is, it's not an accident. They just felt they don't want you to see their dividend because they're not paying a dividend, or the dividend that they're paying is so embarrassing. They would rather highlight other things to you other than the money that you're supposed to be making. I'm gonna continue, and I'm gonna stop here at the balance sheet and return back to my website where I can tell you what I now say when it comes to how do we do this analysis. So we've already done part of it. Already there's a sense of comfort in investing in Lewis, but we don't invest on feelings, we invest on numbers. And then this is where we go to my article. As soon as I can find it. Voila. Okay, just gonna go that route. Had I opened it here or here? Okay. Ugh. Okay. Can I move this bar? This one, wait, man. Move. There we go. Oh, your mouth is moving. And I say, when I buy a share, I look for 4 things to reduce the probability of me picking a bad share. Now I'm saying I'm going to do some work to avoid me choosing that investing is a risky company that you're talking about. Oh, but what happened to Steinhoff? Okay, I'm going to look at these 4 things so that I can reduce the likelihood of me picking up a Steinhoff. And I say, note, a share is a part ownership of an underlying company. I wanted to write that in there so that you know that you're not buying that red dot at the JSE. that nobody understands what makes it go up, what makes it go down. You are actually buying a part ownership in an underlying company. And that is why I refer you to the company website so that you can go and read about the company, read about the wonderful work that they do. I mean, the integrated report is how many pages? 61 pages. It's barely a magazine. It's barely a magazine. Maybe we can say it's double-sided, so it's actually in actual fact double this, so 122 pages. It's barely a book. I'm reading a book that's, how many pages is this? 260. Double an annual report. Just so I can know something about this company that I'm about to invest in. Because we're not speculating, we're going through a thorough analysis. I'm not buying something at the JSE, I'm buying an actual company that exists. I think after I own 2 million rands worth of Lewis shares, I'm gonna go to the Lewis here in town, CBD, and say, I own you guys. My part of the share of the ownership of this company is the equivalent to you guys. When I walk in here, you say, Dumela Rasto, because I'm a part owner of an underlying company. I don't own a blue thing there at the JSE or a red thing that goes up and down. You look at the debt, and I underline here in my article, what is debt? Why do we look at debt? Well, I can tell you now for free. Anyone or any company that does not have debt is in a better financial position than someone that probably has debt. What are we talking about when we're looking at debt? We're trying to guarantee the safety of capital. How do I know this company is not going to go bankrupt with my money? Well, the first good indicator is that they actually don't have any debt, or they have very little debt. Well, let's look at Lewis's debt. Lewis, which makes 7 billion in revenue, has got non-current liabilities here of 800 million. But if you look at this 800 million, it's a lease liability. And those that did accounting will tell you, this just says for the next 15 or 10 years that our shop is in CBD, we have to pay 700 million rands worth of rent. But we made 7 billion this year alone. But for the next 10 years or 15 years, we have to pay 700 million. And that is a non-current liability. That is a long-term liability. What I normally say is you must measure debt against the current assets. What are current assets? Current assets are the things that you can turn into cash either immediately, so you see there's cash there, but there's also financial assets in the form of insurance investments. There's a tax asset, there's trade insurance and other receivables. These are people that owe us money, and there's stock. We can sell our beds there this year, and we will have about 5 billion rands worth of cash that we're sitting on in the current 12 months. And we only owe everybody else in the long term 800 million. That sounds to me like my money is safe. I'm not even going to talk about the non-current assets. We're not even talking about the property, plant and equipment, this, that. We're just talking about the things that we can sell immediately. Makshubile. In the next year, they can bring us 5 billion. And what smart accountants will say is, but normally when you have to do an immediate sale, you're probably going to sell things on a discount. And I say to you, even if I sell it at a 50% discount, I decide that, you know what, I'm selling all the beds, Black Friday. I want all of them to go so that we can pay our debts. We're still going to make 2.5 billion. That still means your money is safe. Safety of capital. I cannot compromise enough on debt. You do not look any further if the debt ratios are not satisfactory, because if you do anything beyond that, you are now speculating, because the definition of an investment says in there, anything else is a speculation. So why would you want to touch a company who, when you look at the cash that they can get within a year versus all of the money that they owe in a year or in the next 10 years, is more than the cash that they can have? If you want safety of capital, why would you invest in that company? And that's why I start with debt. Because if the debt situation is not comforting, nothing will comfort me. Their current liabilities, these are the debts that they have to pay this year. It's 1.3 billion, but we're not worried because the cash that they have this year worth of cash is about 5 billion. And if we even discount it, it's about 2.5 billion. So we still have, after paying 800 million over 15 years, if we pay it this year, if we pay 1.3 billion, we still left with about 400 million. Do you know what that 400 million is? Again, if we come to the statement of profit and loss, that's this year's profit. 483 million is our profit this year. So these guys make profit and it does not disappear to the banks. It is now available for you, the shareholder, to be paid a dividend. So that's the first thing that I look at. I look at debt, and that guarantees me safety of capital. The second thing that I look at is earnings and dividends. Second and third thing, earnings and dividends. And what am I looking for under earnings and dividends? Well, I'm looking for earnings that will give me a return and dividends that will give me a return of more than what the bank would give me. Because remember, we said we're not happy with 8 to 9%. Well, let's look at Louis. What are they doing? If you look at Louis and you look at the profit, so the profit is 480 million, and they say per share, 7.30 Rand per share. Okay, is that good or bad? Is that high or not? Well, let's look at Louis's share price. And I type in there, I look at it via share data online. You open there, and I'm looking for Louis. Louis is currently at 40 Rand per share. So what do you say? You say 7 Rand on my calculator, 7 Rand 30 divided by 40 Rand equals, and you say multiply by 100 so that you get it in percentage terms, you are getting 18.2% of your money back per share in Louis. 18.25%. That sounds to me like a satisfactory return. Then someone will say to me, but Che, that is not the dividend, that is just earnings. And I say, you are spot on, you are right. That is not dividends, that is just earnings per share. That is how much profit they have generated per share, 18%. That belongs to you, the shareholder. But because we've got good management, remember our annual report told us that one of the things that we love is the quality of our management. Through our thorough analysis, they say to you that, shareholder, would you mind if we give you a dividend of, I don't want to move that. If we give you a dividend of 4.13 Rand, which is about more than half of that 7.30 Rand, and we keep the other 3.90 Rand, or the other however much, the other 3 Rand from the 4.30 Rand per share, and we're going to use that to buy more shops, to grow the business some more, to pay off some of our liabilities, to continue to make sure that the business is healthy, it's not risky. That way, we've given you a satisfactory return But some of that return, we're going to use it to continue to maintain the house, to continue to maintain the business. And let's calculate 4 Rand 13 divided by 40 Rand or 39.99, but let's use 40 Rand times 100. That is a 10.3% cash return. This is then what comes into your bank, a 10.3% return. While that 10.3 is very close to the 8.8 to 9%. And I say to you that, yeah, that makes sense, but that's a 8 to 9% return over the year comfortably, but you're getting 10.3%. That is better than what you already got in the bank. But we took 10% of that or 8% of that, and we grew your business. We invested in your assets so that next year you can get an even higher return. The bank says we're going to give you 8% this year, 8% next year, 8% the year after. Louis is saying we're going to give you 8% this year or 10% this year, and we're going to take the 8% that remains and we're going to try and grow the business so that next year we can give you more than the 18.5 or the 10.3% that we gave you this year. And we then have met the definition of an investment operation, which through thorough analysis, white paper doesn't show on this. Yeah, I've been scribbling. Langwatis, I get. Where's that page? There we go. There we go. An investment operation, which through thorough analysis guarantees safety of capital and a satisfactory return. And anything else that you do, is speculation. If you don't do a calculation that shows you how you're gonna get your money back, you are speculating. Yeah, but you know, Diloteta crypto, they go up and down. Joe, nobody knows the future. Okapopa. Yeah, true. But do a thorough analysis. Convince me more. Show me the numbers. Show me the money. So that I can have a realistic expectation. And it says a satisfactory return. It doesn't say it will make your dreams come true. By the way, nobody in investing is offering to make you a multi-millionaire. No. We are not saying we're going to change your life overnight. We are saying that we're just going to give you a satisfactory return. Don't be greedy, but don't be afraid. Let's give you something satisfactory. Let's shake hands and say, we agree that this is good enough for your hard-worked, hard-earned money. The 30% that's our WhatsApp stock fell, what. Don't be greedy. That is not a satisfactory return. That is a phenomenal return. But then do your thorough analysis. Show me how you are going to give me this 30%. If you can't show me, then you are asking me to speculate, not to invest. You are asking me to speculate. And I don't speculate. I invest. I sleep well at night because I know I'm waiting for June so that Louis can declare a dividend. And then I'm waiting for 6 months later in December so that Louis can declare another dividend. When do I make what am I waiting for with your crypto? I give it to Joe. Joe. If a chance, bona last year, this year, is that the entirety of the thorough analysis? Is that safety of capital? It's speculating then. It's speculating. Let me finish off my methodology. After I've looked at earnings and dividends, which give me my satisfactory return, you will see what I did was I divided the earnings per share and the dividend per share by the price. The price is very, very important. That's why I said to you at the beginning of this call that Lewis is not a good investment just because I said so. You still have to go through these criteria. And so far, we've met the first three. Now we're on the last one. At what price should I buy it? Well, I say to myself that I'm not willing to make less money than the bank. And we already saw that at 40 Rand, I can still get a satisfactory return. So yes, today Lewis is a good investment. Go and buy Lewis shares today. You will get your 10% dividend because they have demonstrated to you that they don't have high debts, they don't owe people a lot of money. They can afford to pay you a 10% dividend if you are buying on 40 Rand, at 40 Rand. The same dividend, if the share price goes to 60 Rand and you buy a 4 Rand 13 dividend at 60 Rand, it's going to be a 6.8% return. That's not good enough. So at 60 Rand, Lewis is not a good investment. Leave it alone. It's a good company, but it's not a good investment because you are not going to get a satisfactory return. So leave it alone. Wait for the price to come down a bit. I will brag and tell you that the majority of my clients, I bought Lewis shares for them between 20 and 30 rands. So the client of mine that bought shares at 20 rand, they are getting, if I say 4 and 13, divided by the 20 rand that they paid, they are getting a 20.65% dividend in Lewis. And you sit at home and paying your mortgage and you say investing in shares is risky. And I say my client is getting 20% of their money back cash. The one that bought at 30 Rand, if I say 4 and 13 in terms of the dividend, divide by 30 Rand, they're getting a 13.76% return cash, a cash dividend, 14%. And you're sitting at home saying investing in shares is risky. But you haven't done your thorough analysis. Not doing a thorough analysis is risky. Not entering into an investment operation. You've got your last 1,000 Rand. You quickly want to turn it to 2,000 Rand. So you say, let me try this share thing. That is risky. Don't take your lost money. Save it. Because this is not a short-term operation. The chairman of the board, how dare you disrespect my chairman for the amount of money I pay him, said to you that we offer a phenomenal long-term return. I can't even find it now. Where's that quotation? Yeah, you'll find it in the video. You guys can rewind. I forgot that part. You guys can rewind. But he says that we are giving you long-term return. Long-term is not as long as you have problems. Long-term is at least, with what the information they've given us, is at least 5 years. I say at least 7 years, so that you are comfortable, that you're not rushing this thing. You are relaxed. You know that every year I'm getting 20%, 20%, 20%, 20%. 5 years have passed. Oh, I've got 100% of my money back in cash. 20%, 20%, 20%, 20%. Another 5 years has passed. I've got another 20% of my money back in cash. And talking about buying at 20 Rand, not only did they get 20% in dividends, but they've doubled their actual capital. But I'm not even going to talk about that because nobody can estimate the share price. You just do the calculation that says, if the best investment is 9% and this company pays a dividend of 4 Rand, say 4 divided by 0.09, and it will tell you what the highest share price you should pay for this company is. In Lewis's case, it's 44 Rand. Above 44 Rand with a 4 Rand dividend, you know that you are no longer getting more than 9% dividend, you are getting less. Because if you pay 44, if you buy a share at 45 Rand, 4 Rand divided by 45 Rand is now 8.8% and no longer 9%. Now we are no longer in satisfactory return territory. And that covers my entire investing philosophy. Debt, earnings, investments. Read the article. I think you'll enjoy it a bit more than what looks like my lashing out. I close it off there by saying, how do you find financial statements? I've shown you, you go to the website, you go to investor relations, and then under investor relations, you either should see financial statements or annual report. I chose the integrated report. And that, in a nutshell, is exactly how to invest. 4 years later, none of it has changed. And I leave you with one note, the same note that I got when I finished reading one of these big books. Benjamin Graham says, after you have done all of this work, because as you can see, it has taken us close to 40 minutes, almost an hour. After you have done this much work, have the courage of your convictions. Have the conviction of your work. Believe in yourself. You did the work yourself. Don't let somebody come to you and say, wena, we invested more Louis. Why is it good about it? I hear they say that those ones, they do this and this and that. You've just done a thorough analysis. Why are you going to let somebody that didn't do the work kill your confidence in the investment? You've had a CEO, a CFO, a chairman of the board report to you. You've done your own calculations and they confirmed that they've got good debt management. You saw the investment case. They said one of the investment cases in our business is good debt management. They gave you a 5-year review to show you that, oh yeah, by the way, we are long-term driven. So we're not even afraid to hide our numbers over the last 5 years. And then someone comes and says to you, they took the fridge, yabo mama. I hear they came and they took away the fridge at this and this family. Louis is therefore not a good investment. Someone to talk you out of your thorough analysis that easily. But if I come to you and I say, hey, this bank and that bank don't give you a good return, you would never withdraw your money. That fixed deposit that you've got locked in for 5 years, nothing can shake you. Family members pass away, we need your contribution, you're not willing to take it out. They are in the news because the CEO did this, did that. You make one phone call, the salesperson on the other side says, no, you don't have anything to worry about. And then you don't worry. But your own thorough analysis, you doubted. Have the conviction of your work. Have the courage of your convictions. You worked it out. Nobody told you it's a good investment. You showed it to yourself. You did the calculations. And I can do this exercise for every investment that I've invested in, be it Sibanye, Afrocentric, Transpaco, Caxton, Bowen. I can do the same process over and over and nothing will change. It will company after company after company after company. It will tell me whether it's a good investment or a bad investment. I'm Chairman Mo. Thanks for tuning in. The other stuff I'll record some other time. I think it was important that I speak on the stuff that I spoke about. I think those were very pertinent. I would have loved to speak about the challenges in pricing because that's a topic that has been coming up for me lately these days. And I wanted to actually explain why it's easy, sometimes difficult to give you a price, why it's unethical sometimes to give you a price, why I don't do the Stockfell WhatsApp groups, what, you name it. The easiest thing to do is give me a call, say, Chairman Mo, I'd like you to manage my portfolio. Chairman Mo, I'd like you to teach me to invest. Can you send me an invoice? I send it, you look at it, your eyes get big and you wonder, so much. And then you can come back to this video and say, okay, it's fine. This is exactly what I'm gonna get. Maybe let me pay that fee or let me not pay that fee. Either way, either way, I'm getting a 20% return on Louis. Like, I give a close scam. I'm not interested in scamming you. But if you want the value of my work, my conviction, my knowledge, you name it, I give you a price, you pay it. Look out for the second installment. This was a lovely recording. I enjoyed this one. I think my best by far. If you don't think so, that's fine by me. I don't think I can ever teach investing any simpler than that. I'm going to end by going back to my homepage of my company. I worked hard to create it, so I enjoy seeing it. If you'll just bear with me, there we go. We're a boutique consulting firm that provides legal and business services to individuals and businesses operating within the local and global space. I can do this exercise for Facebook, for Apple, you name it. Cheers, guys.